This Twin Petes Investing Podcast is brought to you in association with ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.
Hello and welcome to the Twin Petes Investing Podcast. My name is Peter Higgins. You can find me at Conkers and I'm here with my brilliant colleague Henry Viola here for Twin Petes Investing Podcast 152. And he said one then. 152. It is past 7 on the 30th of April, the last day of April. And before we start the month of May, and we have hopefully a fantastic dry and sunny bank holiday weekend. Henry, how are you doing, sir?
I'm top of the world, thanks, Peter. Top of the world. The markets have been relatively kind this month. The portfolio is looking a lot healthier than it was at the end of last month. There's been lots of news, lots of takeovers, lots of corporate dealings going on. So it feels like there's a lot to enjoy with the world of investing at the moment. A lot to enjoy.
There's lots to enjoy, but there's also lots of chaos, Henry. Lots of volatility, and the Trump tariffs are still, impeding the markets to have their speed and momentum. Although we've had a bit of a bounce back, as we were saying on the last pod, psychology-wise, stay calm. Yeah, if you've got quality stocks, they should be okay. If you're buying quality blue chips, you should be okay. If you're buying good dividend payers, you should be okay. And we've seen from the lows, FTSE jump more than 10% so far already from its lows. And some stocks have rebounded 10, 15, 25%.
Well, I don't think it hurts that what's his face, Larry Fink over at BlackRock was quoted the other day it might have been the Financial Times. They are piling into UK equities, seeing us as a very undervalued market. And where BlackRock moves, they're seen as smart money, people tend to follow. So could this perhaps be the bottom for the UK markets? I'm not saying I'm calling it, but it does raise the question.
Mate, I'm hoping so. We've got some quality FTSE 350 stocks and other quality stocks below that. BlackRock will be going for the larger ones, I suspect, although they've got, lots of funds and trusts that they can actually explore all the different sectors and sizes of companies. But yeah, I would like to see them doing an RNS every other day, that they've taken a chunk of this and a chunk of that, and maybe even consider purchasing some of the others as well, lock, stock and barrel, because they will be, folks, 30, 35, maybe 40% premium on the quality stocks that these overseas, use the word, predators come for. So yeah, definitely something to look out for regarding our blue chips and or quality small cap stocks, should I say. Right, Henry, just a couple of bits here for feedback and shout out for two individuals amongst all the others that gave us some feedback for podcast 151. One of them we just received today from our superb and continual supporter, a child of the 70s. I'm not sure you've even seen it today.
I did spot that one. I did spot that today, yeah.
Okie dokie. So he came back and he said, very late to the party, but enjoyed listening to this with Conkers and HT Viola. Good discussion on the number of resilient stocks and the importance of keeping a calm head during periods of volatility. Thanks again, both thumbs up. And then we had Grayling, who is at the X account of Tench Blank. And that was going back to April 21st when he first said that, almost straight after the pod went out. Really enjoyed your show. I've been investing in CC8 for around a year, so he's got a chunky 50% plus return on that. And it came out today with news, which I put on X. Really good numbers, and I think it popped, Henry. It popped X amount of percent again today to an all-time high. I put a tweet about it earlier on. So let me carry on what he said. So in CC8 for around a year, and this is one of my best performers. Interesting ideas around Centrica. I topped up Bunzl from the big drop Thank you for taking the time to put these shows together. And then after the bits backwards and forward conversation with you and I, he said, yes, tariffs aren't helping Bunzl, but I'm in for the long run. I would love to hear yours and Henry's view on Chesnara in one of your podcasts. So maybe we can do a little chat on Chesnara, if that's how you pronounce it.
That is how you pronounce it. And not to give too much away, I'm slightly biased on that one, as I've owned it for many years. So as a bit of a preview, I'm quite positive on Chesnara CSN.
Right. Okay.
And I'm happy to discuss why at length on another episode, perhaps.
There you go. There you go, Graylin. You've got your wish. You know,
I think one of the other comments we got was from our good friend Raj, who mentioned preference shares. Now, for those members of the audience that don't know what preference shares are, they're a very specific type of investment asset you can buy. So they're not like regular vanilla equities or bonds. They sort of sit between the two in the capital stack. And where, if the company goes into liquidation, bond holders are paid out first and equity holders are paid out second. If you have preference shareholders, they're paid out sort of in the middle after the bond holders, but before the equity holders, I believe. I've never really looked at them as an investment vehicle because to me, they seem to have all the drawbacks of bonds without really many of the positives of pure equities. In the sense that they're unlike regular equities where dividends can be increased over time. Preference shares tend to have a fixed coupon or a fixed dividend, so that the income doesn't grow. So personally, I would rather just lend money via debt and be a bondholder, and therefore have the extra security, or I would rather buy the equities and have the potential for dividend increases over time. So I've never really looked at preference shares in much detail, but Raj was saying he's had some success with them. He's found some high yielding preference shares in the past that have got taken out for a premium. I think Aviva have actually just cancelled theirs, bought them back off holders for a good premium. And so maybe that is a topic again we can discuss in a future episode. I think that's possibly something worth exploring in a little detail.
Yeah, we can definitely consider looking at that. They were saying, I've just pulled up some notes here, saying types of preference shares: cumulative, non-cumulative, and convertibles. Yeah.
So I used to own a fund that invested in convertible shares or convertible bonds. It didn't do particularly well, to be honest. The idea being that your initial investment is in the form of a bond. So you lend, say, £10,000 to the company for a period of 5 years. Once the 5 years is up, the bond then has the option to convert into equity at a certain price. Now, if the equity price has gone up over the 5 years, you can then get the equity at a discount to the prevailing value, adding more value. Therefore, the bonds become worth more. The equity is worth more. If they go down, if the equity price goes down, however, you still get your coupon on the bond, and you don't have to convert it into equity. You just get paid back like a regular bond. The idea behind the cumulative and non-cumulative, I believe this refers to the suspension of dividends. So with a cumulative, with a regular equity, if you decide to suspend your dividend, the shareholders aren't entitled to any dividends. They're just suspended and that's it until such time as the company decides to either renew the dividend or, goes under or whatever. With a cumulative preference share, those dividends that you would have been paid are sort of stored up in a virtual vault. So let's say you were due to be paid £1 a year and the dividend was suspended for, say, 5 years. At the end of that 5-year period, the company would actually owe you £5. And I'm not sure where it sits on the order of creditors, but they do have to pay out that £5, at least as far as I'm aware, before they pay out things like regular dividends to the shareholders. So you have, like I say, there's some interesting legalities around where your protection sits relative to bondholders and shareholders.
Yeah, brilliant explanation there, Henry. Thank you for that, sir. I'm sure Raj will be happy to to hear your thoughts on those as well in detail. Maybe we'll have to just to do some research on what's out there, or get an expert in. You know,
get an expert in. Dial a friend.
Let's try and locate one. Okie dokie. Right. So on the last pod, Henry, we were talking about quality stocks, and we were at the larger end, in a sense of looking at blue chips, and we covered some quality names there previously, including Centrica and a few others. So I was thinking on this one, we'd go down the pack a little bit, so you can still find some stocks that could be, or investment companies that could be of quality and of interest to our global listeners, so they can go away and research them and consider them accordingly, or just say, you know what, once again, Pete's come out with some absolutely rubbish ideas, or whatever. Yeah,
I like that. I like that a lot. I mean, a lot of the investors I talk to on social media, that write into the blog, and that I meet in person, are most interested in small cap companies. You know, for a whole host of reasons, really. There's lots of positives to them. You've heard that saying, elephants don't gallop. This is the idea that big companies don't grow as fast as smaller ones. It's an analogy, you know, how often do you see a herd of elephants galloping along? Not really at all. Now, a small cap company, the cap refers to the market capitalization. And this is often a question I get asked by people that aren't that clued up on their investing. What's this cap idea? It's how much is the value worth? It's how much is the value of all the listed shares. And a small cap company is typically valued somewhere between £100 million and £1 billion, is where I put it. Now, these businesses often have much higher growth potential than their larger listed brethren. They tend to have a smaller share of their potential target markets. They're often newer, younger companies, perhaps that have developed a new type of technology or product, and are exploring that market. On the flip side, they also come with some higher risks. So because they are smaller, they're often more liquid. There are fewer people trading the shares. So if you went to a very small business and tried to buy, say, £50,000 worth of it, you might find that you shift the share price just by placing that order. The price might jump immediately because the market maker has to put the price up in order to convince other people to sell their shares to you. That illiquidity then leads on to increased volatility. So because you don't have such a high volume of shares on float or on offer, you then also find that the share price moves around a lot more. It's not uncommon to see small caps moving 5 or 10% in a day, whereas you don't really find companies like Google and, you know, Apple moving 10% in a day. Certainly not on a regular basis.
Whoa.
Well,
unless it's during Orange event season. Yeah,
exactly. Unless Donald Trump's just picked up his phone and put something out on Truth Social, and then all bets are off, ladies and gents.
All bets are off. Just caveat it with that when you're going to say things like that, Henry. Yeah.
So you've got to weigh up these pros and cons of investing in smaller companies. But like I say, most the investors I talk to, they like their small caps because they feel that there's a better potential for finding an unloved gem. You know, the big boys can't invest because they've got too much capital to play with. There's not as much research into them. So there's the potential that you find a really undervalued business that's got great growth potential. Now, having said that, I would just like to list off some of the warnings before we go into this episode. So one of the things I often come across with investors that talk to me about small caps is hype. They're absolutely convinced that this company that they've come across is the next, you know, it's going to cure cancer with tap water, or it's going to find an eternal power source based on paper clips, or, you know, who knows what crazy idea it's got. You know, we're going to stop famine in Africa by breeding squirrels. You know, lots of crazy ideas. And often these stories are started by the PR department and the marketing team in the business, and they're then promoted by online influencers You don't know who they are. They've got on bulletin boards, they've got blogs, they've got websites. They might even have podcasts like me and Peter. And then they're telling you, don't worry, we're going to stop starvation in Africa by breeding squirrels. Genius idea, right? You just need to give us your money and we'll give you great returns. Bit of a red flag, to be honest. When you're hearing these crazy hype stories, they are crazy hype stories. The second thing you want to watch out for are serial placings. So again, when you've got this company and they're going to breed squirrels to end famine in Africa, every year they're coming back and they're saying, I know we said we only needed £1 million last year to go and buy some squirrels, but it turns out actually we need somewhere to put the squirrels. We now need another £1 million to build some squirrel hutches. Can we have another £1 million? And the value of your share in the business goes down. And this business comes back the third year and it says, well, now we've got all these squirrels and we've got them in the hutches, but we've run out of money. We need some food to feed the squirrels. We need another £1 million, please. Now, the problem is, if you've not been following along with the story, what's happening here, all that is happening to your equity share, you are owning a smaller and smaller part of this business as they issue more and more shares to raise more and more capital to buy more squirrels, build more hutches, get more food, etc. Not good for you as an investor.
Dilution. Yep.
Finally, you often have businesses with no revenue or profit in this space. So maybe you've got a CEO who tells you, I've got 1 million squirrels in a field and I've built the hutches and I've managed to feed them, right? And now we've got to ship them to Africa. The only problem is no one wants to buy them because who the hell wants to eat squirrels? And I've got no customers. But don't worry, next year I'm going to find someone that's going to buy these squirrels. I just need another £1 million off you to keep me going until I find these people that are going to buy these squirrels off me. Terrible idea, guys. He's never going to find the person to buy the squirrels, right? It's not going to happen. So these characteristics are things that you really need to be watching out for as investors in small caps, investors in any companies, to be honest. And I've given you a completely off the wall analogy here, but
yes, folks,
the principles are there, you know, and what I'm trying to do is illustrate to you the way that these companies sell the story. It all sounds very plausible, very reasonable. They've got the best squirrel breeder in the world, and they've got the connections, and they've got the ships, and they've got the food, and they happen to know 16 ex-presidents of 16 countries, whatever, right? They've got all the patter, but they can't back it up with performance. Your equity gets diluted, and the figures, the financial returns never come, and your investment goes down the pan with the share price. So these are things to watch out for, because so often I get investors coming to me and telling me about these companies and trying to convince me that, Henry, you're missing out on the next best squirrel investment. And actually all you're doing is setting fire to your capital. So Peter, if you can stop giggling for a second. Any thoughts?
I'm all squirreled out, mate. I am literally squirreled out. Welcome to the TWINPETES Squirrel Podcast, folks. I'm not sure where you started from and where you ended up with squirrels. The actual information you shared is absolutely spot on, and it happens on a regular basis, Henry, across large caps and tiddlers as well, coming back for placings and diluting people to the yin yang. And then, you know what? The share price gets hyped, it gets overblown, it gets threefold, fivefold, and they're all going, look at us. And they make some people some money, so they come back and then ramp another one straight away when the first one and the second one has imploded after it's peaked in its price and gone down 58% and 90%. So it goes back to what, I mean, Henry used the word hype. You know, the song's out there. You can all hear it. Don't believe the hype, folks. You've got to go away and do your own research. Have a look at what these CEOs, CFOs, and so on and so forth of these said companies that are constantly doing placings, what have they actually achieved in the past? When did one of their companies that they're involved in actually generate, as Henry said, revenue? Yeah. You know, heaven forbid they've ever generated profits. Yeah. When was the last time that they were involved in something whereby what they said in year one they achieved in year 3, 5, 7, or 10. Yeah, we've spoken about some examples on this podcast before of individual CEOs, chairmen, and so on and so forth, founders of, who have been involved in every single sector of the market, yeah, over the last 15, 20 years, and have never, ever generated a revenue generated company or a profitable company, but have made themselves millionaires over and over and over again from just, what do you call it, Henry? Selling a story.
Selling the story.
Selling a story.
Whilst we're on this idea, whilst I was doing my research for this episode, I thought I'm going to have a little bit of fun and I'm going to go to the dark side. I'm going to go and look at some examples of businesses that fall into this camp that aren't fictional squirrel breeding enterprises. Oh, these are, ladies and gentlemen.
Whoa. Caveat that with allegedly, Henry. Yeah, we want to carry on the podcast. We want to carry on the podcast.
Let's not go slandering the market.
To podcast 153 or 55 or 160. Allegedly.
This is a quick hello to you, our valued Twin Petes investing podcast listener. Whatever channel you're listening to, please make sure to subscribe and you'll always be the first to get the new episodes. Thank you for your continued support.
Because I can just see the bows and arrows now, and the guns being pointed towards the pod.
Don't worry, I've got my squirrel breeding enterprise. If the pod collapses, I'm fine.
Okay,
these are all real businesses, ladies and gents. So everything I'm about to tell you is real. You can go and invest in it. I'm not going to tell you whether to or not. I've got a very strong opinion on that, but I'm not going to tell you whether to or not. Make your own conclusions. The first business develops non-recyclable waste plastics into hydrogen technology. They use non-recyclable mixed waste plastics as feedstock and turn it into synthetic gas. Interesting business. No turnover, loss-making, great story. Hydrogen Utopia International. Have a look at the share price, have a look at the revenue, have a look at the profit. We've got a company that's a software business. We all love software.
Sorry, Henry, that's an avoid. That's an avoid for you, yeah?
That's an avoid for me.
Right,
if you just have a look at the figures.
Okay, that's just an avoid. Quick, go on.
Have a look at, I found another one, a software business. Peter loves his software companies and his technology. These guys develop data analytics software and management solutions. They provide data analytics using a proprietary form operating system. Sounds amazing, right? They operate in the UK, in Europe, in North America. The company is called Rosslyn Technologies, RDT. It's been loss-making every single year for the last 15 years. You can go and buy the shares today if you like, but I don't know why they're going to make a profit next year if they couldn't do it for the last 15.
Whew.
Have a look at the share price, down more or less 95% from peak.
I have seen that. I have seen that historically ramped by a few, individuals.
A few names. I've tried to pick names that jumped out at me, and they've jumped out at me because I've had people approach me about them.
Yeah, and other people have ramped that particular one. I do recognise that particular name. Yeah, it's been ramped a few times by different individuals.
We've got
okie, mate. Yeah, another avoid.
A design and manufacturer of medical drug device equipment.
Drug device.
They operate on the development and commercialization of something called gas polarizer devices and ancillary instruments. If you're completely lost by that description, so am I. The company is Polarean Imaging. The ticker's POLX. The shares are down about 99% over the last 4 years. No profit for 10 years and growing losses. Could people have seen that one coming?
Wow.
That is another avoid for me. And finally, we've got the developer and deliverer of data processing technology. Data processing technology and solutions used in high-end carrier Ethernet applications. Sounds very fancy. Used in the telecoms, mobile, security, and data center markets. Revenues growing rapidly, but they're growing losses as they do. The company is Ethernet Networks. The ticker is ENET. Shares are down 95% over the last 5 years. Now, if you go and look at these businesses online, They've all got lovely websites. They've all got marketing departments. They've all got customer success stories. They've got a fantastic shareholder presentation you can sit and listen to. And I've no doubt if anyone from those companies is listening to me right now, they'd probably, you know, like to go and tell me where to stick my opinions. But
yeah,
as an investor, these to me are an avoid all day long. These are great story stocks that don't have the financials to back them up. Let them go and play with someone else's money. Don't let it be yours.
Wow. I think Henry's been watching some boxing at the weekend between Eubanks and Ben. He's coming out punching tonight. Oh, mate. And that's what? That's just 5 that you've mentioned.
That is
or
just
4,
5.
Is it? I'm losing count.
And
Just
all
5.
And those.
And there's plenty more out there. Yeah, there's plenty more out there of a similar sort of nature. You know, you can buy some quality stock, small ones that are got future, lots of scope to actually develop, slowly generating revenue, slowly getting some contract wins. You've got quality management out there. And you know what? They're not diluting you every 6 months, not coming back with money for the sandwiches and to keep the lights on and so on and so forth. And invariably, it's rare to see one of those sort of companies where the CEO, the CFO are actually going, you know what? We so much believe in this company that we're going to stick another £1 million in it and buy more stock. Yeah. Unfortunately, with a lot of these companies, the CFO and CEO are not doing that. They're getting free, free stock
options
most of the time. Stock options, yeah. Free ones. Oh, when we get the price of this and whatever. But it's rare you see them digging into their pockets and going, nah, you know what? We're not going to do another diluted placing. We're going to put another $1 million in, another 2 million in, another 5 million in. Because if they were to believe in the company as much as their marketing suite are telling everyone else, they would do so. But I'm not sure where I put my book. Where have I put my book?
There's madness of crowds behind you.
Where's my book gone? I did have my book with me. Oh, yeah, it is. This is my book by John Kay, folks. And if you can see the title of the book, we'll move it around a little bit.
Other People's Money.
The book is called...
That's a fantastic film.
Yeah. Other People's Money. Masters of the Universe or Servants of the People. Yeah. So the dilution and them always taking their salaries, even when there's no money left, and they're coming for a placing, it's either going to go kaput or we want some more money. They want to play and be rewarded with other people's money. Your money, my money, Henry's money, not their own. Yeah. So if they're that serious about the company, let them play with their own money. And as Henry says, those 5 companies and the others that are out there that are being ramped and, showcased everywhere that are tiddlers, and you look at how many placings have they had? Just avoid them. You don't need to go there. And if it multi-bags and you go, oh, you know what, Henry's slagged that company off a year ago. Look at it now, it's gone up 3-fold. Yeah. What happened to the other 4 or the other 5 that have now delisted? We had an example of another stock. I'll just say about it briefly, Henry. Argentex. Saw people ramping that and talking about that recently. And the share price has gone for, 95% of what the last price was available to shareholders, or something around that sort of ilk. That was meant to be a quality company involved in FX trading. Gone. Might as well have been gone. 2.49 pence from wherever it was before, 48 pence. What? Don't do it. Don't have to follow other people. Do your own research. We all make mistakes. We all get stocks wrong. Best thing to do about it is not to ramp the stocks that you truly, haven't got the heart to say, I'm not quite sure if this story is going to play out. Yeah.
Well, that's the thing. I mean, we
don't ramp any stocks.
The reason I don't go, the words escaped me. The reason I don't wax lyrical about Chesnara, for example, which I own, I don't want you to buy it. I don't really want to influence you on it, other than to say I buy. I'll discuss it as factually as I can. I'd rather talk about DGI 9, which I still hold, which came out with a shockingly bad update at 5:45 tonight.
Wow.
Have a look at the share price, ladies and gents, because that was in my top 10 at one point. I still hold it. And wow, did I get that wrong? You know,
I got it wrong too, Henry. I got it wrong too.
But this is the thing, and at no point there, and there's some blogs out there that are still trying to make out DGI9 massively undervalued. This is £2 a share. It's £1 a share. And it's 80 pence a share. Now, don't worry, right? I've done some maths, and there's Excel spreadsheets floating around showing how this is £1.20's worth of NAV if X and Y and Z happens. The official valuation from today, 35 pence or something, and that was 4 months ago. So God knows what we're at now. So just when people are waxing lyrical about the companies that they hold, they're biased. We're all biased. We all want to think that we've found the next Google before it becomes Google, but we're biased. And that's why what Peter and I try to do on this podcast is actually just talk about the facts of what's in front of you, and ask you to go away and come to your own conclusions, make your own decisions, and disagree. People disagree with us all the time, and that's what investing is about. It's about having your portfolio run your way, not trying to double guess what we've done and copy us.
Absolutely spot on, mate. I'm going to digress here, Henry, because we were both in DGI9, and it was today, 1 year ago, on this day last year, the 30th of August, 30th of April, sorry, I went, nah, I'm done. Took a massive chin on the chin, rattled my jaw, took the financial hit, took the loss, 21 pence, then I went, I'm done.
I wish I'd got 21 pence.
See where it is today. It's 8 pence today, Henry, and plus a little bit of change. You know what I mean? So I got it, and I got it completely wrong. I was like, yeah, they're going to do that. Yes, the assets are worth that. Anyway, so we're going to digress and come back to a little bit of quality stocks in a minute. But I need to share this story because I was having a conversation with two individuals, including John Stepek today, and we ended up talking about gold, Henry. We'll get back to, and there's a reason why I'm talking about gold before we get to the quality stock I'm going to talk about. So we had Gordon Brown, the Chancellor of the Exchequer.
I know where you're going with this.
You're already wincing. Who decided to sell approximately half of the UK's gold reserve in a series of auction. This amounted to 395 tons of gold, which is sold for an average price of $275 per ounce. For the $275 an ounce, and sold the quantity for $3.5 billion, Henry. Yeah. Today, today, Henry, considering between 1999 and 2000 was near gold's 25-year nadir, lows. With the current price right now, Henry, let me just see what I've got it here. I've got it here somewhere. Yeah, I think the current price is $3,275 dollars per ounce. That would be worth, Henry. Let me just I've got my numbers right here. Yeah. Would be worth something in the region of $45 billion.
And
not 3.5, but around $45 billion. Instead of 3.5, the amount that he sold.
Oh, well, that's Rachel Reeves' black hole sorted for 2 years running and some change.
But we don't have that gold anymore, mate, to fill it with.
Oh, God.
Yeah. So we're having that conversation today, and I was like, how much did he leave on the table there? There's arguments that he's trying to help the euro and this, that, and the other. And I'm like,
I am blaming your generation all day for that one, Pete. I'm sorry. You could have stopped
my
him.
Generation. I didn't.
You could have stopped him. I was too young. I was at school. It wasn't my fault.
I don't know if I could have stopped him, mate. I do not know if I could have stopped him.
Oh, what a mess.
Right. So why am I mentioning gold, Henry? I'm mentioning gold because of a particular investment trust. We've had gold on the move, and from its nadir of 2000 and the past 25 years, and including the period of time when the Chancellor of Exchequer, Mr. Gordon Brown, was selling it off at an average of 275. Gold has proceeded to climb and outperform the S&P over the past 25 years. Everyone goes, the go-to place to be is in the S&P. Buy and forget. The gold with its cycle is up 1,078% over the past 25 years. It's gone a bit wappy over the last 3 months, 6 months, year. And I think if there's some quietness from the orange event person, then it might roll over a little bit and might fall a little bit. It's peaked recently. And equally, it may not. It may go higher if the US goes into recession, or there's a a domino effect of
Dominoes
more
falling.
of this trade war, trade war and tariff stuff. Anyway, I digress. I'm wanting to talk about BlackRock Energy and Resources Income Trust, Henry. An investment trust that focuses on companies operating in the mining and energy sector. Its objective is to provide long-term capital growth and income through investments in those industries. The trust aims to achieve an annual dividend target whilst offering exposure to businesses that drive economic development, such as those involved in renewable energy, oil, gas, and mining. Recently, they completed a share buyback program with 130,000 ordinary shares repurchased. They were under the cosh of the Saba Capital situation, which they came to an agreement with in January, which means that Saba are basically going to stay away from them and not give them any more grief until at least 2027. But the reason why I'm speaking about this is because at the time in January when they came to this agreement, the shares for this trust were about £1.2425, and they're currently sitting at 105. The NAV is 117. Discount to NAV is 8.3%. Dividend yield is 4.1, which is not too shabby. And what I like about this particular one is that it pays a quarterly dividend, so you get paid every 3 months. Yeah, so every 3 months you get your little dividend coming into your account, and so on and so forth. Let's talk performance now, Henry, before I get into the bits and pieces that it holds. 1 year performance down. Yeah. 3 year total returns down. 5 year total returns 162%. Now, could it get back to anywhere near that in the next 5? I do not know. 10 year total returns performance 103. Yeah, and this sits quite nicely on the 5 year base, on a 10-year basis, across the commodities and natural resources AIC sector performance. For the average ones that are in that sector is 60.7. Theirs 10 year is 103.7%. Now, what does it hold? The holdings that it has at present, some companies that you would have heard of: Anglo American PLC, Rio Tinto, Targa Resources Corp, Shell PLC, which is going through its own activism stuff, Permian Resources, Vertiv Holdings, Norsk Hydro ASA, EOG Resources, Glencore, and ConocoPhillips. So it's got some quality plays within the portfolio. That's just the top 10. Yeah, it doesn't make up more than 50% of its holdings, but it showed the quality at the top end of what's going on. I've got to caveat what I'm saying about the quality of this portfolio, because at the moment, the other aspect of it, we talked about gold being part of it, and obviously, regarding the commodity side of it, other commodities are available in the portfolio, but we talked about gold because it's at its high. Oil and energy is another aspect of it. It's been in a downward trend, and currently we're sitting at Brent crude trading at 62.75. It's down on the year. Biggest monthly fall since 2021, losing 15.4 and 17% respectively for Brent crude and West Texas Intermediate. So on the decline. If and when oil prices rise because of different sort of news flow, that could then help the portfolio. If it's something recessionary, not going to help it. What's the other bit I've got here? Global oil demand growth has been revised down, Henry, to 730,000 barrels per day, reflecting economic uncertainty. So given all the tariff noise we've had, all the uncertainties already also impacted the oil price because of all the uncertainty, and oil supply, what's coming out of the ground and being made ready for usage, has also risen. So I think the word they use is what, Henry? There's currently a glut. Yeah. Has risen by 590,000 barrels per day, with non-OPEC plus countries leading the increase. So you see, there's uncertainties, there's less usage, and actually there's more available to actually sell. So right now, you've got a situation which needs to be balanced. Yeah. Right, so that's the reason I'm talking about that one. I like the look of it in a sense of it's a small tiddler, market cap 127 million. It's a discount currently of 8.3. They've had some activism going on. At the time when they concluded that, it was at 124. It's currently 105. The 52-week range on that is 87.8 pence to 129.5. And it's sitting at the lower end of that, or you could say in the middle, if you want to be pedantic. And if things were to sort themselves out and oil and energy starts to go back to where it should be, and those holdings that it has in some quite, significantly quality companies globally, I think they could do well whilst he's still getting paid 4.1% whilst you're waiting. Yeah. Smaller, little tiddler one. Any thoughts, Henry, on that one?
I'm not a huge fan of it, if I'm honest, and I quite like resources businesses. Yep. I like the logic. Forecasts are down, so commodity prices are depressed. Therefore, the NAV is probably towards its low point. It's unloved. Buy now, wait for the recovery. The bit I don't like is the fact that you could buy all of these businesses directly and just cut out the management fees from BlackRock on the trust. So if you wanted to go buy Rio, Conoco, Shell, etc., you could just go buy these directly right now and just hold them and not pay the 1.4% or whatever it is to BlackRock to buy and sell them on your behalf. Having said that, you don't know when they bought them, so they've probably got a better basis price than today. So, it's not as simple as just go and get them yourself. But it's not one that leaps out at me. I think the other thing that I'm not overly keen on is the performance of the trust over the last couple of years. So it's been down, actually.
Not been great. Last 3 years,
23, 24.
Yeah. You've been paying them. And again, you've been paying them to hold it, mate. That's what you've been doing.
Exactly. So I'm paying BlackRock to make me money with these holdings, and actually they're losing me money. So what am I paying money for?
Yeah. So that's why I'm looking and thinking over the past 10 years, they've actually managed to do that.
Yeah.
Positively. So can that 3-year nadir that they've had
be
sorted out? And that's essentially what attracted Saba. They were going, you're not performing, guys.
Yeah.
And ladies, you're not performing. So, let us do it for you.
And to be fair, BlackRock are known as a very good leading name in the industry. They're not known for making stupid investments and burning money, unlike Triple Point, who destroyed DGI 9 and goodness knows what else. So it's an interesting name. I like some of the top 10. I'm not overly keen on the oil and gas, but I'm not going to get on my soapbox about that one. But I like the fact we've got an investment trust in there as well. Perhaps one to go away and have a look at. Am I right in saying the ticker's BERI?
BERI, yeah.
BERI.
BERI, yeah.
BERI.
That's the ticker symbol for it.
So one to go and have a look at, I think, ladies and gents.
And it's not that I see a lot of people talking about Henry either, other than when it was involved in the Saba Capital activism bit.
Yeah.
Which they resolved back in January.
BlackRock All World Mining is one I hear all the time.
I've never
actually heard of BERI before. So
that's the one you'll hear of.
Whether you are an experienced or new investor, you know how valuable it is to conduct portfolio enhancing analysis and to have easy access to data that will give you the edge. As a Twin Petes investing podcast listener, you can access an exceptional offer, the UK's #1 investment data and analysis software for private investors and traders. This special Twin Petes offer is available to new subscribers only, and you can subscribe using the promo code TWINPETES. The incredible and exclusive offer means that monthly subscribers will get their second month free, and annual subscribers will get their 13th month free. Sign up and subscribe today using the Twin Petes promo code, and you can save up to £69. Visit sharescope.co.uk for further details and subscribe to the investing and trading analysis and data you need.
Nice, I like it,
mate. Okay, I'll over to you, and then after that, I'll just update people on where we are with Menphys.
Yeah. So coming back to these quality small caps that you could own directly, perhaps. A lot of the criteria we're looking for are similar to the large caps. This doesn't change. We're looking for strong cash flow, balance sheet discipline, low debt, not diluting shareholders. We want ownership stakes. We want a long track record. I want to be seeing positive returns on capital employed, revenue growth, profits over 10 years. Even if small, I want to see that the management can perform. And a name that popped up when I was doing my screening, little difficult because I don't want to be talking my own book, so I've discounted ones I own. This is one I have no position in. FDM Group Holdings, the ticker is FDM. It's a £245 million market cap company that provides a variety of IT services. Primarily IT and business consulting with a focus on application development and testing, support, project management, data service. You're really thinking of an IT consultancy when you think of something like FDM Group. Now, as Pete and I have mentioned on the podcast a few times before, data is increasingly valuable. And here in 2025, it's driving more decisions than ever before. We've all heard about the leaps that AI is making, but you've got process automation, which is being driven by data sets, and large-scale decision-making systems that are driven by data sets. It's powering entire industries, from how companies are speaking to us as customers to how they manage their supply chains and how they respond to market shifts. What do you do when Donald Trump suddenly slaps 145% tariff on China? Ask your data set. Data is becoming increasingly central to everything that we do. But there is a bit of a catch to this. Just having access to a huge database doesn't actually give you any intelligence whatsoever if you don't know how to use it. So while businesses are collecting more and more data from more and more sources, not all of them actually know what to do with it. And that's where companies like FDM Group come in. They help companies by providing data and analytics consultants to turn raw data from thousands of different sources into meaningful insights, help them to spot patterns, identify opportunities, and solve problems before they become catastrophes. Now, it's more than just reporting this. It's more than just taking what's historically happened and telling the board about it. It's about extracting real strategic value from the data that you've got and helping to inform decision makers and help them to make decisions in the best possible way. This is really at the crux of what FDM does. Now, the business has got a very robust balance sheet. It ended 2023 with a cash balance of about £47 million, which was up slightly from the previous year. It's got strong cash conversion, 112%, no debt, which I like. It's got strong returns on capital employed over the last 10 years. I think the average was about 55% when I went and had a look. And it pays a 7.2% yield, which is covered. It's available on a PE of 14. So this is a quality business. It's a business that's not about to go bankrupt from having debt, pays you a nice yield, and it's not terrifically expensive for what it is. And this is the sort of business to me that screams quality, that makes me want to go away, learn more about its competitive advantage in the industry and how it stacks up as an opportunity to invest in. Any thoughts, Peter?
You've said all the magic words there to me, Henry, bar one. And I'm waiting for you to say my magic word was AI. How much of AI are they utilizing within the business to speed things up, to make it more efficient?
They will be
and so on and so forth.
Over it.
Are they all over it?
I am.
How much of their revenue is generated from AI?
I
how are they enabling other companies to utilize more AI, or are they doing the research to give them to say where to apply AI? You know, everything you said there, I'm thinking, why haven't I looked at them before? It's a company I've seen, Henry, and I've seen the name about for a long while. I've never done deep research on it. So I'm going to have to go away and have a look at that. You've said all the right things, data analytics, this, that, and the other. I'm going, it's got to be AI. It's got to be AI. It's got to be in there somewhere. But I want to know which way they're involved in it. You know, are they the facilitators of it, or are they actually utilizing it for the companies that they're doing and getting they're probably doing it to crunch all the data very, very quickly for everybody.
Exactly. So you think about data storytelling. The best way to imagine you've got 1 million data points. The human brain can barely comprehend the number
Absolutely.
1 million, let alone create a story from it. AI can do that in seconds. So to me, AI will be at the core of what they are doing.
Yeah. And then following on from that, Gen AI as well.
Yeah.
And I'm going to be happily give you a little ching for that one. I'm going to go away and have a look at that one, mate. You forced my hand because it's one I've had for a long time with. Yeah, I know the name. I need to go and look at it. I haven't done it. What market cap did you say it was? What size is it?
245 million.
That's respectable, mate. Respectable.
And that's actually down quite a bit. The share price has come off its peak.
Yeah. Yeah, it's come off its peak. Ready for me to have a research of it and buy it, mate.
Exactly. There you go. You see.
I will go and have a look at that, sir. No, that's a good call, Henry. I like the fundamentals of it as well. You know, sounds like they've been quite prudent, and because a lot of these smaller companies think they have to get to where they get to by being acquisitive, and they don't always bed all these down very well, and it comes back to bite them in the rear. They spend all the cash. Well, we've got all this cash. We generate all this cash flow. Let's go and buy our competitors. Let's go and buy this and that and the other, and they put all this mishmash together to try and weld it together, and it doesn't sometimes. Yeah, all the different cultures, all the different cultures of the companies doesn't blend, doesn't go well. Yeah. Okay, mate. I'm going to give you that one. I like that one, Henry.
Excellent.
Yeah. And I'll be going away to research that over the bank holiday. Despite the fact that the bosses, we've got the royal family visit again, mate. Yeah. This weekend. Yeah. Yeah. Where the two bosses will be doing their thing as I'm running around with a pity on, looking after all the other, be about half a dozen people here, if not more.
You need to get yourself an AI assistant, Pete.
An AI bot, yes. Yeah.
There you go. You see,
get one of those garden robots to take the drinks across the garden.
Pete's gone to the pub. Here's AI Pete. He'll be catering for the weekend.
Absolutely. Right. Yeah. So I'm not sure how much time I'm gonna have this weekend. Right. So a big thank you to everybody that's donated to the Menphys fundraise, of which we're trying to generate funds to help them put together an employability program for our young people and young adults suffering from disabilities, trying to get them to the place where they can be, which is to be semi-independent, not fully independent, with a job of their own and building their esteem and employability. That's what we're trying to do with this particular fundraise for 2025. You can find it on the TWINPETES Just Giving page, which will be all over all the different platforms that you can find. We are at 34% of our initial target of £5,000. We're at £1,772. We had a donation, or I'll do it in reverse order, from Child of the 70s, thanks again to Peter and Henry for their continued great work on the podcast and efforts to spread their knowledge and experience. All the best. Neil, thank you ever so much, sir. Donation of £50 and £12 gift aid. That will be absolutely fantastic. Thank you very much. Jane Croucher, thanks for a great podcast and supporting a great cause. £20 from you, Jane. Thank you ever so much for listening, and thank you for your donation. Our friend Matthew Gregory, thank you again, Matt. I think that must be multiple donations you've given that so far, so thank you ever so much. A little Easter present. Keep up the great pod and keep shining that light of kindness in these worrying times. You both do the hardest thing. You lift people up, not push them down. Wow. Fantastic words. Thank you ever so much, Matthew. £25 and £6 gift aid. Really appreciate your kind words there, Matthew. Really, really, really do, mate. Touched by that. And then we had Dave Fish 12 days ago. Thank you, Dave. And Dave's words were a worthy cause, and I continue to enjoy your Twin Peaks podcast, even if I don't always agree with your reviews. Smiley face. Keep up the good work, both yourself and Henry, and I hope you reach the charity target. Thank you for that, Dave, and thank you for your honesty as well. You don't have to agree with us, mate, and we actually prefer if you don't. You know,
that's what it's all about.
You'll say you like, I'll say I don't like it. You make up your own mind.
That's what it's all about.
And this is what it's all about. You know, don't ever go away and think Henry says it's a good one, Pete says it's a good one, therefore it must be a good one. We get it wrong all the time. Yeah. And we encourage everybody to go away and do their own research. We cannot say that enough. We're not experts. We've talked about enough of our losers on this pod, unlike other people on pods. We get it wrong all of the time. All about education for us on the pod, and we're learning every day. And every day the market gives us another lesson, and we go like, oh my gosh. Yeah, there is no gurus out there, folks. Yeah, do your own research. Right, so thank you all very much. And did I say what Dave donated? Dave donated £20 and £5 gift aid. So thank you, Dave. And if you haven't done so yet, please, please, please find the Just Giving page. Just type in Twin Peaks Just Giving 2025 on the Just Giving page, and also have a look on the platforms that you're finding the pods on, and on YouTube, and on my website, and sometimes on Henry's website as well, for the Just Giving page. And please, please, please make a donation so we can help these young disabled individuals get into employment. Thank you very much. Henry, any words?
Yeah, just a thank you to everybody that does donate. It's not an easy time at the moment out there economically for an awful lot of us. Prices are going up at a horrendous rate. Mortgages have already gone up at a horrendous rate. Bills are going up at a horrendous rate. Taxes are going up at a horrendous rate. You know, it's difficult, you know, to be perfectly blunt, to put your hands in your pocket for people that you've never even met, that you never will meet, actually, and donate to the cause. But it makes a world of difference. It really does, to people that really genuinely need it. This money is not for me and Pete. This money is for children and their families that really do need every bit of support that they can get. So everybody that has supported, thank you. To everybody that's thinking of donating, please do. If you go on to Just Giving, search for Pete Higgins, search for the Twin Peaks Investing Podcast, you will find the 2025 link. If you look and you can't find it, message us, let us know. We will send you a link. But also consider sharing it. Share it on your social media feed, share it to friends and family that might consider donating, because this charity needs every bit of support it can get. And more importantly, the children that it supports need every bit of help that they can get. So thank you to everybody that's donated, and thank you to everybody that will donate.
Thank you ever so much, Henry. Yeah, just search the Twin Peaks Investing Charity Challenge 2025 and you should be able to find it on the Just Giving page. Thank you, ladies and gents, for that. Henry, do you have time for one more? And I've got one more after that, I think. Very quick one.
Yeah, just a quick one. So I've got another one I think you're going to like, Pete. This is slightly larger. It's a £487 million market cap charging, billing and customer relationship management software company.
Sounds like a story stock, Henry. Want to stop you there?
Sounds like a story stock. It's got a great story, though. There's no squirrels involved in this one, though.
Oh dear. Go on.
The company is Cerillion PLC. That's Cerillion with an E, not an A. The
Right.
ticket is
Sorry, let me stop you there. Can
CER.
we pronounce it Cerillion,
Oh,
not
is it
Carillion?
Cerillion?
Sir,
Cerillion.
but it's with a C. It's Sir. I pronounce it Sir, so it doesn't sound like Carillion.
Cerillion. Cerillion. Well, we'll call it Cerillion then.
Right. Okay.
So Cerillion was founded in 1999, would you believe, following a
Wow. So younger.
management buyout from a company called Logica, who I think I was,
Logica.
7 years old at the time.
Love
So I
that.
don't really
Love that
remember them.
history
I was too
lesson.
busy sticking crayons up my nose.
Wow.
So Cerillion provides comprehensive billing, charging, and CRM software solutions, predominantly to the telecoms sector, but more recently also to other industry sectors, including finance and utilities. Now, they reckon that they've established a reputation within the global telecoms market for being a leading supplier of carrier-grade enterprise billing software, supporting fixed wire, mobile, broadband, and telecom services. Their solutions are now used in about 80 individual customer installations across 45 countries. So this is a pretty big business, pretty well geographically diversified business. And the reason this one caught my eye was simply because it's a business that's it's in a niche. Now, small caps, one of the benefits of investing in small caps is that they often operate in overlooked bits of the economy with very limited competition and therefore significant pricing power. Think, the only provider of X in the UK or the top 3 supplier of whatever in Y. And to me, Cerillion sounded a little bit like this. Billing software in telecoms, I don't know of many suppliers. Maybe there are thousands of them, but this one certainly sounds like a pretty good niche to be in. And as you would expect from a company operating in a niche that's a quality business, it's got a great return on capital employed, 26%, which says to me it's a quality player. So straight away, this jumped out at me as a potential small cap, quality name. I might want to go and do a little bit of research on. Pays a little bit of a yield, 0.8%. Personally, I'm questioning whether that's worth getting out of bed for, but it's 4 times covered, which means that there's significant room for growth there. So if you bought some shares today at 8 times at a 0.8% yield, and they grow those dividends every year for the next 20 years, what do you think the yield's going to be in another 20 years' time if they grow them every year? You could end up with your original investment getting paid out in dividends if they grow the dividend fast enough. I'm not suggesting that's what they're going to do, but this is the sort of thing that catches my eye, where I go, this company's got potential. Interesting story, interesting sector, interesting niche, quality business. Any thoughts, Peter? He's paused.
No, I'm pausing because obviously it's another tech company, yeah, software again, billing solutions. It's very competitive space, Henry, isn't it? Yeah. So I think you mentioned some metrics there. I'll be looking at what the margins are, if they're thin or fat. If they're chunky, then obviously they're doing quite well in their niche. And it's a sort of company that's, if I'm remembering rightly, they've had some periods of time where they've had some really good wins, contract wins, and so on and so forth. But they're in a very, very heavy space, mate. So it's always about renewals and extensions and winning new contracts.
Yeah.
And if that slows down, and if we hit this recessionary phase, or some of their larger competitors actually become even more competitive and more efficient, they're competing against the behemoths in that billing space. So it's one of those companies which I'd be concerned that the pipeline has always looked good, but the actualization of that pipeline has always been consistent. Does that make sense?
Yeah.
So that's why you've had the share price fluctuate over the years. I'm not sure where it is in the range of where it's been in the last 1 year or 3 years.
It's down slightly. So it's grown consistently. It's gone from about £2.50 a share all the way up to about £20 a share, and it's currently sat at £16.50. So it's slightly off its 52 weeks high.
I'll shut up there then, mate. If it's gone from 2 to 16 and whatever, but they've done extremely well, Henry. My question would be, could it continue? Yeah, it's getting more and more competitive.
Well, the interesting. One of the things that caught my eye on this was actually the growth. So again, we talked about elephants not galloping, right? We've got a little hair here about to take off. Well, it has taken off. They're operating. You asked about,
yes.
We've got the whole gamut of wildlife today. The operating margins have actually increased over time. So if you go back to 2019, their operating margin was 13.5%. In 2024, it was 43%.
Wow.
Their dividend cover in 2019 was 2.3%. Their dividend cover in 2024 was 4%. 4 times.
Yeah.
Again, their gross margin has improved as well, 74% up to 80%. So all of this is saying to me, this started out as a healthy business, and it's actually getting healthier. Their revenue's gone up, their margins have improved. There's a lot to like here.
Okay.
Now the share price has responded accordingly. You know, like I say, you could go back and buy it at £2. You're now paying £16.50 for it.
Yeah.
But if you're going to have that mindset of backing winners in the market, this kind of looks like a winner to me.
It's got a chance, Henry. I'm just going to go here and I've pulled this up now. So trading update, which was, where are we? A couple of weeks back. H1 trading update. Revenue expected to be 20.9 million versus half year 2024 of 22.5, with difference reflecting the anticipated higher weighting of software license renewals extensions to the second half of full year 25 compared to full year 2024, when the majority of renewals extension occurred in the first half. Then you go on to adjustable EBITDA, which not many people like, is expected to be 10 million versus H1 24 of 11. So that's a good 10% lower, or thereabouts. Positive here, using your metrics, which you love. Net cash at 31st of March is 31 million. For a small cap holding 31 million, that's quite tasty. So yeah, there's a few bull points there, Henry, and a few bear points there for me. So I'm gonna have to sit on the fence on this one, mate. I think we'll know, Henry. Interim results to be published around mid-May. So 2.5 weeks or so. You'll either say, I told you so, or I'll be going, I'm not saying anything to Henry about Cerillion.
Yeah, exactly. Yeah? Don't worry, the audience will come and tell me I'm an idiot. Go back to your squirrel farming, mate.
Yeah. And the other positive was January's major new contract win was worth $11.4 million. So they're still winning contracts and they're getting renewals and so on and so forth. So it's one of them in May, folks. Henry's research idea, Cerillion, ticker symbol CER. Keep an eye out for that one. See how it goes. Let us know your thoughts on it in the replies. Give the podcast a retweet, give it a comment, and let us know your thoughts on Cerillion and all the other stocks that we've spoken about. Yeah, good one that one, Henry. I'm just concerned about the space it's in, mate. And it's come a long way from 2 quid to 16, mate. So, you know, yeah. Okay. I'm going to go for one that's not done as well, but I'm hoping could get up there. Right. And this is a little footsie tiddler. Market cap of 64 million, Henry. 52-week range of 41 pence to 53 pence. A PE of 12 and a yield, this is what gets me interested in, is 9.55. Everyone loves a nice chunky dividend dropping into their portfolio every now and then. Share price currently is 47 pence per share. I'm talking about Hansard Global PLC, Henry, specialist long-term savings plan provider based in the Isle of Man and maintains operations in the Republic of Ireland. offers a range of flexible, tax-efficient investment products within life insurance policy wrappers developed to appeal to affluent international investors.
That sounds like
Offers
a tax
range
avoidance
of
ruse
around.
to me.
I'm not even finished. Be gentle, mate. Come on. Offers a range of 200 flexible, unit-linked, long-term savings and investment products in tax-efficient life assurance policy wrappers. These are sold exclusively through 540 independent intermediaries to around 43,000 policyholders in over 170 countries. Yeah. Given the tariffs, they might have to pull the money out, mate, in those 170 countries. Who knows? Right? Products are issued by Hansard International and Hansard European. Now, I discovered this company, mate, because I was doing some research and some work for Menphys, right? And we were looking for some foundations and some charitable, entities out there that could maybe support us. And unfortunately, the reason I came onto this was because of the founder of Hansard Global, which unfortunately wasn't good news when I discovered this. Had passed away in March of this year. The chap's name, the founder and controlling shareholder, was Dr. Leonard Polansky, CBE, who passed on the 17th of March, 14th of March, sorry, the news came out on the 17th of March. He began work in the financial services sector in New York in 1955, gaining experience of working in Rome, Frankfurt, Zurich, before establishing Liberty Life Assurance Company Limited in London in 1970. Hansard Global, its successor, was listed in London Stock Exchange in 2006. So they're coming up for the next year, will be their 20th anniversary being listed as a company, Hansard Global. And the reason why I'm speaking about him and this particular company is because Dr. Polansky, his legacy is one of being a philanthropist as well. And his legacy will live on through his Polansky Foundation, a UK registered charity that supports higher education, cultural heritage, and the arts in the UK, the US, Israel, and Europe. Given all of his works he did and all the good stuff he did, he was recognised in 2013, and he was named the Commander of the British Empire CBE for charitable services by Her Majesty the Queen Elizabeth II. So he was a founder. The son, Mark Polansky, is a non-exec. Non-exec director. I don't think he's a director. But this company is all involved here in investment products, including regular premium savings plans, etc. International presence, it includes offices in Malaysia, Japan, Dublin, and we mentioned Isle of Man already, Henry. The last update was back in early March, covering the 6 months, and they reported 777.8 million in new business, a pre-tax profit of 5.3 million, 1.15 billion, this is how small it is, in assets under management. But I'm interested in this because of, not necessarily because of what Mr. Dr. Polansky did, but also because it's yielding 9.55 as we speak. And I'm hoping you can tell me what the div cover is, maybe, because I haven't looked at that. But given that they're still growing and the affluent individuals still have money to spare, despite all the other stuff that's going on, I suspect that they could do okay going forward. It's one that's now on my watch list because I wasn't meant to be looking at the stock. I ended up looking at the stock. But I suspect it could do okay, Henry. And my way of looking at it is here, right? It's yielding, let's round it off, 9.55. So let's round it up to 10%. You're buying it at 47, 48 pence per share today, tomorrow, next week, or whatever. If it drops down to 44 pence or 43 pence, the divvy's been wiped out. Yeah. You get the dividends at 44 pence, you're back at break even-ish. If it doesn't move anywhere, you're going to be compounding 9.5% for the next 2 or 3 or 4 or 5 years. If you get some good news and the share price goes to 50p, yeah, you're compounding at 12% per year. If it gets to 53 pence, you compound it and so on and so. So that's the reason why I'm talking about this little tiddler, folks. I think it's a quality little nano cap, I want to call it, 64 million. Over to you with your boxing gloves on, Henry, to absolutely smash this one to ribbons with your grimacing face and say what you need to say.
Well,
speak up. I can't hear the punches.
Well, I hate it.
You hate it.
I hate
Oh my Lord, not even starting gently. Go on.
Oh, Peter, what have you dug up here? I mean, what a dog of a company this is. So first of all, the thing's tiny.
We've had the squirrels, we've had the hare and the rabbit, and now we've got a dog. Oh my gosh.
So pull this thing up on ShareScope, right?
Yeah.
First thing I have a look
Which
at.
I haven't, but listen, caveat this, I've not looked at the ShareScope metrics on this one before I spoke about it. I just got carried away with the philanthropy side.
Shame on you. That might explain why you found this. So you've looked at the yield.
Listen, we've got long-term listeners to this podcast who know that even if I look at the metrics on SharePad, I'm always going to pick a dud. So carry on.
So first thing I see, forecast PE of 38 times. Forecast PE of 38 times for a tiny.
It's not.
That's what SharePad's telling me. We've got a negative return on capital employed. We've got zero growth in the dividend. The dividend's been rebased twice, and it's been flat for the last 4 years. So although you have got this 9.5% yield, they can't grow it. That dividend's uncovered as well.
It's uncovered.
So it's uncovered.
Oh gosh.
So I've got no idea how they're paying that out. You know, this has got a lot of red flags to me. Go on.
Can I make an admission? I'm hating it too now already.
I'll put Peter right.
And this is what happens when you don't do your fundamental research, folks. Oh my gosh, Henry, that's horrible.
So you know,
gosh,
we've got gaps all over the data. You know, the PE is wildly inconsistent, which says to me the earnings are all over the place. The return on capital is all over the place. You know, 1 year, 2012, we're up at 30%. The next year, it's negative 5%. Then we're up at 4%. 2 years later, we're down at negative 20%. What the heck are these guys doing on the Isle of Man? I mean, flipping heck. Well, you know, that's less running a company and more just flinging numbers at the wall by the sound of it. You know, I've got a debt to free cash flow ratio here. And bear in mind, ladies and gentlemen, I can't actually read this number. It's so big. It is 6,530,219,459,687,219. What's that? 6 trillion and something.
What?
The quality of this data is so poor, either they are not reporting accurate figures. I mean, there's so when I'm seeing figures like that on a company, Peter, geez, I tell you what, if you were my financial advisor and you brought me this, you'd be fired,
listen, mate. I'm going to say it today now, the last day of April 2025. I am not going to come on here with a stock that I've not put through the ShareScope fundamental screen again.
Right, ladies and gentlemen, you're not seeing Peter Higgins again. I'm feeding him to the squirrels on the squirrel farm. That's it.
That is bad. Those are bad numbers, mate. Even I hate that stock now. Oh my gosh. Listen, apologies, folks, for wasting your time for the last 5 minutes. Thank you, Henry. I'm glad I asked you to pull those up before someone else came and piled on social and said, "What the hell were you talking about, Pete?"
I think we're putting that in the category of the story stock, ladies and gentlemen.
Oh gosh.
By accident.
Listen, apologies, folks. I will make it up to you on the next pod. I'll come back refreshed, recharged, fully researched on the next pod. Yeah? On the next pod. Oh, dear Henry.
So now you picked yourself up off the floor.
I'm punching myself here. Right. Okie doke. We've done 1 hour and 15, Henry. Is there anything you want to add, sir, regarding the pod, things you've seen, any comments about anything else before we go?
I think just generally thank you to everybody that's writing in. We are getting more comments. We're getting them on YouTube. We're getting them on social media. Please do keep it up. It's lovely to hear from you. Stay safe on the markets. It is volatile out there. I know I opened with a fairly upbeat message. I want to keep that upbeat tone, but be careful. This market is volatile as anything. Who knows what's going to happen after this podcast goes on air? But uncertainty is the only certainty. So be prepared, keep your eyes peeled, and don't take anything for a dead cert, because there is no such thing when it comes to investing.
Spot on, mate. Spot on. I completely agree with you. Ladies and gents, do your own research. Henry and I cannot stress and reiterate that often enough. Please be safe. You've worked hard for it, for the monies that you've got in your investing portfolios. It's prudent to try and keep that money and squirrel it away and try and sweat it as much as you can to make long-term investment returns. You do not have to take additional risk with the smallest core stocks out there. You can get rich slowly, and that's possibly the best way to do it. Who would have said that over the past 10 years, just buying some gold bars would, over the last 25 years, would generate 1,078% return? No one would have done, but that might have been the safest bet, given the volatility we've seen. Outperform the FTSE, outperform the S&P 500. Voila. So there are safe bets out there. Please consider them. Ignore all of the ones that I've spoken about tonight on this podcast. Go away and research the ones that Henry has spoken about, and come back and let us know. Please give us a retweet and a like on YouTube, on X, and Blue Sky. Let us know your thoughts on the pod. Thank you so much for your continued support. Thank you for those that are still listening to pod 150 and 151 and giving us feedback regarding our time at the Master Investor Show, which seems like an absolute age away now, but we thoroughly enjoyed it, and we appreciate your kind feedback. Ladies and gents, have a fantastic May bank holiday. Henry and I will come back and see you all in 2 weeks' time in the month of May. And we look forward to hearing from you. Henry, thank you ever so much, sir. Thank you for the low blows and the punches. I deserved them thoroughly this time. I will come back. I will do better. I will not let the team down. And I will see you in 2 weeks' time, folks. Henry, I'll speak to you soon. Take care. God bless. Love to the boss as well, mate. Okay? Love to the family.
Ditto.
Ladies and gents, take care. God bless you all. And we'll see you in 2 weeks' time. Bye-bye for now.
TWINPETES Investing Podcast is brought to you in association with ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.